Right now, we will start the next chapter, chapter 5, a financial statement analysis of banks. So, in this chapter, we will discuss financial statements of a bank and analyze financial performance of banks by using finance. Now, we'll start the next chapter, chapter 5. Right. Let's look at the bank financial statements. So bank financial statements, it has two things. Number one, report of conditions, the financial conditions, the financial situation or financial strength of a bank. Financial strength means what? How much amount of assets, how much amount of liabilities and ownership, right? It has. It shows assets and liabilities. So that we can find in bank's balance sheet and performance, whether the bank perform well, whether the bank earn profit, sufficient profit or not. So that can be understand from by looking at income statement. And you might studied in accounting and other subjects. Report of conditions. Report of conditions. Financial condition. The bank balance sheet of a bank showing its assets, liabilities, and net worth. Assets, liabilities, and net worth mean equity capital at a given point in time. So when you look at the heading of balance sheet, you might say balance sheet or statement of financial position as at, right, as at 31st March 2025, like that, on the point in time, not interval, it's a point in time, may be viewed as a list of financial inputs, source of funds mean where the bank is going to get fund, and the output, how the company use that fund for making loans, like that. Right. When you look at the balance sheet, you can find there are asset sides and liability side. In the asset side, cash mean the liquid cash. Securities mean the stocks or bond or debentures which are tradable in the market. So those are securities. Loans mean the amount of money given to its customer for the purpose of earning interest income. That is loan. And other assets, as the assets like they may invest in real estate, apartments, or other assets like gold, like that, or other property, plant, equipment, furnitures, like that. So those are asset side. The major liability of the bank is deposit. Customer deposit is a major liability. Another borrowings to settle unexpected withdrawals by the customers, depositors. The bank may get some amount of money from other banks, other borrowings coming under other borrowings, or for any other purposes. Banks may get a loan from central bank or other bodies. So that also coming under other borrowings. Other liabilities like income tax liabilities, rent payable, electricity payable, salary payable, gratuity payable, right? Long-term loans. Those are coming under other liabilities, and equity are the ownership capital. Stated capital plus retained earning. So financial output financial input. Financial output, it shows how does the bank use its money, use its input. Mainly cash assets. Cash asset. It may include cash in wallet, reserve equipment, so reserve requirement with the central bank, deposit with other depository institutions. So the cash include the amount of money they have in their hand plus the amount of money deposited in the central bank as a reserve requirement, and the bank may deposit in other banks if they have additional money, right? Rather than invest that money in the stock market, they may deposit such money in other banks. So uh, that also include cash assets. Investment in securities, money market instruments such as treasury bills, commercial papers. So those are the short-term securities. Money market instrument. Money market means short-term instruments. Loan and leases. Loan and leases. The bank may give a loan to its customers in the form of lease, vehicle lease, or loan, housing loan, business loan, education loan. So there are many form of loans, type of loans. Those all types of loans and leases coming under this. Miscellaneous assets. Fixed assets such as branch network, computers, premises, property, plant, equipment, everything is coming under miscellaneous assets. So those are the use of fund. Use of fund. Financial input, this means where the bank are getting fund to run their business. Here, deposit from the public, right? Public deposit. The banks are heavily depends on public deposit. The bank managers are responsible to attract sufficient deposit from that area. That's why the banks are establishes branches, island-wide branches. Retail or corporate deposit, interbank deposit. Retail deposits from the bank collect deposit from individuals. Corporate deposit, the deposit from companies, a big amount of money deposit by the bank, by the companies and government. Interbank deposits. So one bank deposit into another bank. Say commercial bank deposit money in the people's bank account. So like that. So those are deposits, interbank deposits. And non-deposit borrowings. Non-deposit borrowing, discount loan from the Fed mean the government, federal government. Discount loan and loan from holding companies or other banks, and equity capital is on money. Balance sheet. Balance sheet normally the basic formula asset equal to liabilities plus equity capital. So this is basic formula. When we apply this basic formula in the bank's aspect, C mean cash, S mean securities, and L mean the loan provided to its customers plus other assets, miscellaneous assets, right? So these are assets. Equal D mean deposit from the public, and non-deposit borrowings, the loan plus equity capital. So this is the fundamental equation of the bank. Bank assets mainly cash. Cash account is the cash held in the bank's wallet and deposits due from deposit institutions, right? The bank also deposits some amount of money in other financial institutions. So that also be considered as what cash. So why do banks keep cash in their hand, in the wallet? Meet the need of liquidity for deposit withdrawals and demand on loans and other unexpected needs. So why do banks keep loan? Right? So depositors, they withdraw money, and the new customers apply for a loan or to meet day-to-day operations, say salary payment. To make salaries, they have to keep some amount of money. Rentals, building rental, or utility bills. For that, they have to keep a sufficient amount of money there. It includes wallet cash, deposit with other banks, so correspondent deposit, cash items in a process of collection, so it's called uncollected checks, reserve account with Federal Reserve. In our context, it's central bank, right? Reserve account with central bank. Sometimes called primary reserves, right? The cash are called primary reserves. Balance kept low as a little or no interest income. So normally, the banks keep minimum amount of cash. Why? When they keep cash in their hand, they have to forego. They have to, they lost their interest income. Next, investment securities. Two types of investment securities. One is liquid portion, secondary reserve, and the income generating portion. The cash is called primary reserve. Primary reserve cash, and the as a liquid portion, highly liquid assets, say stocks. If banks need money immediately, they can sell that stocks at the bank, at the stock market. So those are reserves, secondary reserves, but it take time, 1 or 2 days. Liquid portion, income generating portion, right? They may purchase debentures for the purpose of earning interest income, or they give a big amount of money to other some investments, right? For that investment, the purpose is to making profit, say real estate. The banks may uh, put money on real estate for one for if they are going to make long-term profit gains. They are getting rental income. Liquid portion, investment securities available for sale is often called secondary reserves. It's the backup source and includes short-term government securities, privately issued money market securities like interest-bearing time deposit with other banking firms, bank deposit that has a specified date of maturity, example, certificate deposit, saving account, and commercial papers. The income generating portion held to maturity securities are bond, notes, and other securities held for expected rate of return. So these are this portion, uh, right? Mainly they invest to get income. Trading account assets. Trading account asset. Securities purchased to provide short-term profit from short-term price movement, right? They purchase securities at lower price and they're selling at higher price. So this is what trading assets, like especially the stocks. When the bank acts as a securities dealer, securities acquired for resale are included in this account. Reported at fair value or market value, right? Normally these assets are expressed in financial statement, especially balance sheet, in terms of book value, not book value, in market value, right? In market value. Trading assets may include treasury securities, mortgage-backed securities, foreign exchange rate contracts, and interest rate contracts. Federal funds, so central bank fund, right? When the central bank fund sold and reverse repurchase agreement. So this is kind of asset, bank asset, reverse repurchase agreement. It's a type of loan, right? It's type of loan given to central bank, given to government. Generally temporary or overnight loans. So it's a very short period of loan, right? So it may settle in 1 or 2 days. Provided to depository institutions, securities dealer, or industrial corporations. So federal fund, say central bank fund, the fund comes from deposits held at central bank. Reverse repurchase agreement, it means bank takes temporary title to securities owned by the borrower, right? So borrower already having securities, so that securities given to its bank, right? Bank. It is the sale of securities together with an agreement for the seller to buy back the securities at a later date. right? Again, they will buy back. The bank assets, a loan and leases. So this is the primary assets of a bank. The significant portion of the bank's assets are invested in loans. It's a major assets of a bank. The type of loan are broken down into similar features such as based on maturity, collateral, pricing terms, etc. The common one is the based on purpose of borrowing money. Here, the commercial and industrial loan, the loan given to companies or projects for business purposes, consumer loan, so individual loan, housing loan, wedding loan, education loan, foreign trip loan, right? And mortgage lending and real estate loan. So mortgage, pawning, right? When the customer apply for a loan, they give their house or valuable properties as a mortgage, as security. That time it's called mortgage loan, a real estate loan, financial institution loan, right? So they may give loan to other financial institutions like other banks or insurance companies like that. Foreign international loan, right? The bank sometimes give loan to other countries like uh, our government get loan from other countries. No? Likewise, some countries, some companies outside of our country may get loan from a local bank. So that coming under foreign loan or international loan, agricultural production loan for the purpose of agriculture to motivate agriculture. It's a specific form of loan. It's given to the farmers. Security loans aiding investors and dealers, and leases purchase equipment or vehicles and give rent to other business clients. So gross loan, right? So there are some terminologies in the bank financial statement. The gross loan is the sum of all outstanding loans. Sum of all outstanding loans. Net loan equal gross loan minus loan loss allowance. Like what do you call in accounting, you may study provision for doubtful debt. Provision for doubtful debt. Likewise, here also they provide a provision. Some customers are failed to pay that loan. For that, they have to make some arrangement. That's called loan loss allowances. Both current and projected loan losses minus unearned income. Unearned income. Banks give loan to customers that does not pay, right? Expect interest. Bank give loan at 10% interest, but they not paid that interest, right? Uh, that's called what? Unexpected. The bank unable to cover expected return from that loan. Anyhow, they receive its principal amount. Unearned discount income. Interest income on loan received from customers but not yet earned. That's called what? Unearned discount income. Allowance for possible loan loss, like doubtful debt. Reserve for the future loan losses from the income based on the recent loan loss experiences. Right? Anyhow, certain portion of the loan is it's not performing. So it's a contra assets account. So they have to write off some of the assets, loan assets, and represent accumulated reserve from which the bad loan be can be charged off. Bad loan mean the amount of loan which are uncollectible. When a loan is uncollectible, accountant write it off in the books by reducing all or decrease assets account. The bad loans normally do not affect current income. Allowance for loan losses. How do they decide? The allowance for possible loan losses is built up over the time by annual deductions from current income. Is known as provision for loan losses, like what provision for doubtful debt. It's a non-cash expense item that appears in the income statement, and provision for loan loss is debited, whereas allowance for loan losses is credited in the balance sheet. So beginning of balance sheet, balance of allowance for loan losses. Uh, it's what called what? Provision. It's a provision for doubtful debt. Provision for doubt opening balance. It's always credit. Provisions are always credit. Provision for beginning balance of allowance for loan losses plus provision for loan loss equal adjusted allowance for loan loss minus actual charge of worthless loan, right, of bad debt, right, written off as a bad debt. It's equal net allowance for loan losses plus recoveries from the previous charge off. So it's a what? The bank already written off as a bad debt, but later the banks received from that bad debt equal ending allowance for loan loss. This is the formula. Specific or general reserves. Allowance for loan loss account is divided into two parts. One is specific reserve, general reserve. So you might study it in accounting. Specific provision and general provision for doubtful debt. So specific reserves set aside to cover a particular loan for a particular individual or particular loan customer, which be a above average risk. Designate a portion of allowance loan losses or add more reserves to allowance for loan losses. General reserve is common for all. So remaining allowances for loan losses determined by management but influenced by taxes and government regulations. What do you mean by non-performing loans and miscellaneous assets? Non-performing loan, right, is a non-current assets. It's a non-current loan is a category of loan which doesn't accrue interest income or have to be restructured to accommodate borrowers' changed circumstances. Loan is placed in the category when scheduled repayment is past due for more than 90 days. No, the bank normally gives loan for 1 day, 1 month, but the customer cannot uh, pay back that loan within that 30 days. Then the bank gives some sort of flexibility to that customer and installment basis, say 1 month loan make into 3 months loan. So this is called what? Non-performing loan. Miscellaneous assets include the bank premises and fixed assets, the land and buildings, real estate owned, real estate investment to compensate non-performing loans, and goodwill and other income. So it's other assets. So when you look at the bank balance sheet, it's look like this. So point of view, the bank versus customer. So when you receive money, you will get 25. Right, the customer here bank says the bank will credit your deposit account. Why they credit? Customers view the deposit as an asset. Customers point of view the deposit as assets, but the bank point of view it's a liability, right? That's why they always say it's a credit. Therefore, customers think credit equal assets. Bank liabilities. First, the deposits. Non-interest bearing demand deposits. Normally the current account. For current account, normally banks are not charges, not pay interest. Non-interest bearing demand deposits permit unlimited checks writing, but cannot pay interest rate. The second type of deposit is saving deposit. So it received low rate of interest with minimum cease requirement, of deposits and permit the customers to withdraw at their will. So this saving account, you can deposit your money in your account whenever you want. You can deposit via ATM. But anyhow, we have to maintain at least a minimum amount of money in their account. Money market deposit account is a short-term deposit. So money market deposit accounts pay competitive interest rate with limited checking privileges. Normally 7 days prior notice is required before withdrawal of money. Right, money market accounts. This is not a long-term deposit. It's a short-term deposit. So normally they deposit a huge amount, a big amount of money. The customers deposit, but the condition is before withdrawal they have to give at least 7 days notice. 7 days notice. If you give notice today, we can withdraw the money after 7 days. But it gets high interest rate. High interest rate. Now account means negotiable. In negotiable order of withdrawal. Negotiable order of withdrawal. Severe interest and checking writing facilities. No, there are some customers, they are deposit a big amount of money. The interest rate are decided by the negotiation between the manager and customer, right? The depositors go to bank and deposit money, and sometime they want to withdraw that money. That time the manager try to convince the customer, so don't withdraw that money, keep that money for a period of time. We will provide attractive interest rate like that, right? So they have make some sort of a negotiation, and also sometimes they give some privileges to write check as well. Time deposits a fixed deposit, right? For that they give a certificate of deposit. A time deposit, fixed maturity terms, stipulated interest rate. So they already predetermine what is the rate of interest is. Non-deposit borrowings, no reserve requirement or insurance fee required, that reduces the cost of fund and makes it flexible, but interest rate is highly volatile. During the time of financial problem and crisis, lender may refuse to extend credit. And sources are money market, federal fund purchased, that means central bank purchased, commercial papers, euro markets, long-term borrowings. So these are the non-deposit borrowings. So sometimes the bank also borrow money from other side. Equity capital. Equity capital. As a company, they have their own capital, ownership capital. It's called equity capital. It represents the owner's share of the business. Finance institutions are most highly leveraged of all businesses. The capital account normally represents less than 10% of the total assets, right? The banks are heavily dependent on the deposits. They convert deposits into the loan. Anyhow, the central bank set minimum amount of capital. So if the bank has more capital, they have less chance of insolvency risk. Preferred stock and common stocks. Preferred stock, you know that preferred stock. Common stock is called ordinary shares. Common stock outstanding, capital surplus, retained earning, right? Undistributed profit, and treasury stocks and contingency reserves. So those are coming under equity capital. Off balance sheet things, as we explained, as we discussed earlier, there are some off balance sheet items. Banks have converted many of their customers in recent years into fee generating transactions that are not recorded on their balance sheet. For example, standby credit agreement, right? The bank and customer at an agreement. Whenever a particular customer apply for a loan, the bank has to make arrangement for that. The bank cannot say, sorry, I can't do it at that moment. If that instances, the customer may file a case against that bank. So the bank taken a liability. So this until the bank customer get the loan in this condition, the banks are not shown that provision in their balance sheet. Bank pledged to guarantee repayment of a customer loan received from a third party. Interest rate swap, right? So when you look at the previous slide, interest rate hedging method, you can find a section called interest rate swap as a mechanism, as one of the mechanism of hedging interest rate risk. Right, the bank promised to exchange interest payment on debt securities with another party, financial futures and option interest rate contract. Bank agrees to deliver or to take delivery of securities from another party at guaranteed prices. Loan commitment, bank pledged to lend up to certain amount of fund until commitment matures. Foreign exchange rate contracts, bank agrees to deliver or accept delivery of foreign currencies. So these are the off-balance sheet items, right? Assets and liabilities in equity equal debit and credits. At any point in time, balance sheet debit equal balance sheet credit. The major component of income statement, when we look at the income statement of a bank, it's totally different. It's totally different from other conventional organization, right? So it shows how much it has cost to acquire fund and to generate revenue from the use of fund in reported conditions, right? How the bank make profit. First, interest income. Right? When you look at the income statement of a bank, the main source of income is what? Interest income. Interest and fees on loan and interest on investment securities. So these two are the main source of getting income. Interest and fees on loan. That's a major part. Interest on loan. Interest expense. Deposit interest cost. Interest on short-term debt. Interest on long-term debt. So these are the major expenses. When you look at the conventional bank, conventional business organization, non-finance companies, at first, like you can find revenue, sales minus cost of sales, right? Sales minus cost of sales, you will get gross profit. But when you look at the bank or finance institutions statement, you can find interest income that's equal to sales, interest expenses that equal to cost of sales. Then the difference between these two equal, but net interest income, net interest income. And non-interest income, it's called what? Other income. Other income in the non-finance companies, you can find a section called other income. No, likewise, in the bank's finance statement, you can find a portion that non-interest income. Fees earned on fiduciary activities, right? Right, the bank earns some amount of money using providing depository services, locker services, asset management, portfolio management, collateral, right? Bill collection. For that, they collect some amount of money from the customer. For that, they receive some money. That is other income. Service charge on customer deposits, trading account, gain and fees, additional non-interest income, investment banking, security brokerage, insurance services. Like a bank may purchase some sort of assets, securities in the stock markets. From that, by buying and selling that stocks, they may get some sort of profit. But that profit also coming under other income. Non-interest expenses. The main expense of the bank is interest expense. So what are the other expenses? The building, the bank has to pay income, rent expense, have to pay salaries, and have to pay some other utilities, right? Wages, salaries, personal expenses, cost of maintaining of properties, rental fees on office spaces, like that. Provision for loan loss expenses. It's like what? Uh, Provision for doubtful debt, like that. Extraordinary items, sale of non-current assets. Interest income, net interest income equal interest income minus interest expenses. Net non-interest income equal non-interest income minus non-interest expenses. Pre-tax net operating income, profit before tax. It's called what? Profit before tax. How do we calculate? Net interest income plus non-interest income minus provision for loan losses. Income before extraordinary item. It's called profit before tax plus securities gain or loss minus tax. So when you look at the income statement, always debit and credit. Over any period of time, all debit equal to all credits. So when you look at here, expenses, income statement, cost item, revenue item, always revenue item is higher than expense item. The difference between, right, the cost item and revenue item is called profit, right? The difference between revenue item and cost item equal to profit, right? That profit considered, the profit considered as a increase in equity. The profit is belongs to whom? The owners. Therefore, that will be added to the equity or retained profit, right? An increase in asset value sometime, right? That equity, right, increases, profit increases may increase the amount of cash, right? Cash is an asset, or it may increase in other form of loans, right? Expenses. A cost item is high, then the revenue item this time is called loss. It's a loss. The loss always erode or reduce the equity, erode the equity. So it's a loss. So this is the typical income statement of a finance companies. All right. So revenue, main revenue item is what? Interest income plus interest income minus interest expenses is called net interest income plus non-interest income, right? It's called total revenue minus uh, provision for doubtful debt, that is provision for loan losses, non-interest expenses, then you can get total expenses. Total revenue minus total expenses equal income before income taxes minus income tax equal net income. Right, fees earned from fiduciary activities like when a customer keep current account, every year they have to pay annual fees and they have to pay for the checkbook fees. And credit cards, every year we have to pay annual fees, right? Annual fee, that's the income of them. Fees for managing, protecting customers' properties, right? Like safe locker system. Fees for record keeping for corporate security transaction and dispensing interest and dividend payment. Right? Some companies hire banks to record their transaction. For example, when the company is involved in IPO, instead public offering, there are a lot of transaction that companies are unable to handle this kind of major issues. So they may appoint a bank to collect money. So that part is done by the banks. For that, the bank may charge a fee on that. Fee for managing corporate and individual pension and retirement plan, right? So gratuity and pension. So on behalf of the company, the bank take responsibility of that. Service charges on deposit account, checking account maintenance fees. So checking account mean what? Current account. Checking account overdraft fees, OD fees, fees for writing excess checks. So they may they may limit per month 5 checks or 10 checks. If they go beyond that, they may charge an additional fee. Saving account, overdraft fees, and fees for stop payment of checks. For that also they may charge. Trading account gain or fees in stock market, they buy and sell stocks. Net gain and loss from trading cash instruments and off-balance sheet derivative contracts that have been recognized during the accounting period. What are the additional non-interest income? Investment banking, advisory services, brokerage, and underwriting services. From this, the bank may get non-interest income. Venture capital revenue, net servicing fees, net securitization income, insurance commission fees and income, net gain or loss on sale of loans, net gain or loss on sale of real estate, net gain or loss on sale of other assets. So these are the non-interest income of bank. So this is the basic formula. Net interest income minus provision for loan loss equal net income after provision of loan loss, plus or minus non-interest income equal net income before tax, plus or minus security gain or loss, trading assets, minus taxes is called income before extraordinary item, minus extraordinary item or loss, and net income minus dividend, minus called retained profit and distributed profit. So these are the features, right? Features and consequences of bank finance statement. So please read it. Cash flow, the cash flow statements. What are the source of cash for a bank? When banks face financial difficulties, they can raise funds by sale of the assets, by sales. So they decrease in assets, or they can get loan, so that will increase the liabilities, or they may issue additional shares, that is may increase capital account. How banks use the cash? Why the banks right use the cash? For meet day-to-day expenses, increase in assets in the form of loan, decrease in liabilities to settle their deposits in form of withdrawals, and to settle their loans, and decrease in capital accounts. Sometimes they may repurchase of their stocks. After that, the next section will be evaluating performance, evaluating performance of banks. There are formulas to evaluate performance of financial institutions, banks. We might study the value of stocks, one method. And this is dividend discounting model, the pricing model. You might study it in financial management, valuation of stocks, right? The present value of the stocks is depend on present value of future cash flows. And to evaluate the bank performance, we might use some sort of ratios. So these are the ratios. Please go through this. And this is the diagram. Uh, and it illustrates the relationship between the ratios and how these ratios are got expanded. So please look at this as well. So the formulas, please look at these formulas and return on asset formula. So please go through these slides. And risk, fundamental risk, there are many formulas to evaluate the credit risk, liquidity risk, market risk, operational risk, capital or solvency risk, legal risk, distribution risk. So I have included all risk management. How do they deal with this each kind of risk? Please go through this. And CAMEL model, which is the primary model to evaluate uh, performance of the bank. So C means capital adequacy, A means asset quality, M means management quality, E earning quality, L liquidity level, S is a sensitivity to market. So CAMEL model, please focus on this model, CAMEL model. It's well-known model to evaluate the bank performance, right? CAMEL rating. Okay, that's all today. Please go to the slides, and I have a few more slides share with you.